Friends, imagine if I tell you that one of the world's top hedge funds, which beat the S&P 500 by 20 to 30% for years, it ran on just one simple mathematical formula. And the most shocking thing? That formula is so easy that even a 6th grade kid can apply it. Yes, this is not a joke. This is not magic. This is the real, tested, proven method created by Joel Greenblatt. And to explain this method, he wrote The Little Book That Still Beats the Market, a book that will take you on such a journey today where you will understand. Checkmark, how the market makes mistakes. Checkmark, how simple logic can make millions. Checkmark, how you can pick good companies without complex analysis. Checkmark, and how a simple strategy beats the world's smartest investors. So let's begin the story. The first truth of market and reality. Joel Greenblatt says a very deep thing at the beginning. Short term, the stock market is a voting machine, but long term, it is a weighing machine. What does this mean? In the short term, people keep voting based on checkmark emotions, checkmark news, checkmark fear, checkmark greed, checkmark useless opinions. But in the long term, only one thing wins: the company's real financial strength. And the magic formula finds exactly this strength. Joel Greenblatt's main question: is it possible to consistently beat the market? At the beginning of the book, Joel asks the biggest question: can a common person beat the market? Can he outperform professional investors? Can he benefit from the market's mistakes? Answer: yes, and very easily. But easy does not mean it happens instantly. Easy means logical, straightforward, systematic. But yes, discipline is required. Foundation of the magic formula: wonderful company plus cheap price. Joel says, great investors always do one thing. They buy amazing companies, and they buy them when they are cheap. That's it. The entire book revolves around this concept. Now the question: checkmark, how to identify a wonderful company. Checkmark, and how to identify a cheap company. That is where the magic formula is born. The correct way to identify a good company: return on capital, ROC. Joel explains, the world's simplest and most powerful measure is how much return a company can generate on its capital. This is called ROC, return on capital. Example: if a company invests 100 rupees and earns 50 rupees, right pointing arrow, ROC equals 50%. Another company invests 100 rupees and earns only 10 rupees, right pointing arrow, ROC equals 10%. Now which company is better? The one that earns more with less money, right pointing arrow, that is the good company. And which companies have high ROC? Checkmark, strong brand. Checkmark, great management. Checkmark, monopoly-like conditions. Checkmark, selling products with high demand. Checkmark, new competitors cannot defeat them easily. Greenblatt says, higher the return on capital, better the business. The correct way to identify a cheap company: earnings yield, EY. You found a good company, but sometimes good companies are very expensive. And the biggest rule of becoming wealthy is, buy a great company, but at the right price. To measure this price factor, the magic formula uses the second number. Earnings yield, EY, equals how much profit a company generates every year. Right pointing arrow compared to its market price. High earnings yield equals company is cheap. Low earnings yield equals company is expensive. Magic formula equals high ROC plus high earnings yield. Meaning, checkmark, amazing business, high ROC, checkmark, available cheaply, high EY, equals magic formula stock. And these are the stocks that give extraordinary long-term returns. Why is the magic formula extraordinary? 3 real reasons. Book-based. Greenblatt explains, the market is a factory of mistakes. In the short term, market prices are almost always wrong. People's fear, greed, and hype distort prices. The magic formula exploits these mispricings. It is completely evidence-based. The magic formula is built on years of data. Checkmark, 17 years of backtesting. Checkmark, 3 different market periods. Checkmark, consistency even during market crashes. Checkmark, high ROC plus high EY stocks outperform the average market by a large margin. It removes emotions completely. This is the biggest USP of the book. The magic formula is a system where your mind, your emotions, your fear cannot interfere. You simply follow the ranking. No emotional decisions. Only system, right pointing arrow logic, right pointing arrow discipline. The biggest truth about the magic formula: short term, it will always look like a failure. The book says, and this is the most important part, checkmark. In the first 3 to 6 months, the magic formula will look useless. Checkmark, in the beginning, you will often see losses. Checkmark, some stocks will fall heavily even over several years. But the truth is, short-term pain equals long-term gain. The beauty of the magic formula is that because it looks weak at the beginning, most people abandon it, and those who remain become millionaires. Joel Greenblatt's real-life example from the book. Joel gives an example. There are two companies, A and B. Company A, checkmark, amazing business. Checkmark 60% ROC checkmark monopoly-like product. Checkmark, very efficient operations, but the market is ignoring it right now, equals stock price low. Company B, checkmark weak business. Checkmark 6% ROC checkmark heavy competition. Checkmark, no competitive edge. Checkmark, only trending temporarily, equals stock price very high. The magic formula will choose A, not B. Even though B may rise in the short term, long term, A wins. Understanding this psychology is the main wisdom of the book. Investor behavior, the biggest enemy. Greenblatt repeatedly says, the formula always works, but the people who follow it always fail. Why? Because they don't have patience. The book emphasizes again and again, checkmark, the strategy is excellent. Checkmark, the market cannot defeat logic. Checkmark, the data is clear. Checkmark, history is proof. Still, 80 to 90% of people lose because, checkmark, they panic. Checkmark, they sell after seeing low returns. Checkmark, they break the system emotionally. Checkmark, they get trapped by short-term noise. Grand summary of part 1. In this first part you learned, checkmark, the market often misprices stocks. Checkmark, the measure of a good company is high ROC checkmark. The measure of a cheap company is high earnings yield checkmark. Magic formula equals high ROC plus high EY checkmark. It is completely data, logic, and discipline-based. Checkmark. Short-term weakness is actually the strategy's power. Checkmark. Beating the market is possible, but beating your emotions is necessary. Now that you've understood that Joel Greenblatt's magic formula is actually built on only two principles, high-quality businesses plus buying cheap, now it's time to understand it more deeply so that you can actually use it for your own investing. The two metrics with which you can beat the entire market. Greenblatt says that if you can correctly understand just two things, you can earn better returns than 80 to 90% of professional fund managers. Those two metrics are 1. Earnings yield, how cheap the stock is. 2. Return on capital, how high the business quality is. Now let's understand both in depth. 1. Earnings yield, how cheap is the company? The book explains that earnings yield basically tells you how much the company earns relative to its value. Greenblatt uses a special formula to measure this. Earnings yield equals EBIT/enterprise value. Now you might be thinking, why EBIT? Why not PE ratio? Greenblatt says, PE ratio is often misleading. Company loans, cash, interest, depreciation, none of these are clearly visible in PE, whereas EBIT, earnings before interest and taxes, shows you the company's true operating earnings. And enterprise value shows you the company's true cost including debt and cash. Therefore, the book says, the higher the earnings yield right-pointing arrow, the cheaper the stock is considered. And what does the magic formula do? It creates a list of the cheapest stocks based on earnings yield. 2. Return on capital. How great is the business? Now comes the second thing, company quality. Greenblatt says the quality of any business can be understood by asking, how much profit does the company generate from the money it spends on machinery, equipment, and working capital? This is measured as return on capital, ROC, equals EBIT/net working capital plus net fixed assets, meaning less money plus more earnings, right pointing arrow, great business. More money plus low earnings, right pointing arrow, average or poor business. Companies that earn 30 rupees to 40 rupees on every 100 rupees of capital. Greenblatt calls them superstar businesses. Magic formula finds such high ROC businesses. How does the magic formula combine both metrics? This is the beauty of the book. What does the magic formula do? 1. First, it ranks companies based on quality, ROC. 2. Then it ranks them based on cheapness, earnings yield. 3. Then it adds both ranks and selects companies with the lowest total rank, meaning high quality plus low price equals perfect investment. This is the magic formula. Greenblatt's important warning. This formula does not work every year. The book explains, for a few months this strategy may look terrible. Sometimes even for a few years the market may ignore it. Sometimes it performs worse than the market, 1 to 2 years. But, Greenblatt says, in the long run it almost always beats the market. Historically, Magic Formula's annual return has been around 15 to 22% per year, much better than the S&P 500. But it works only if you follow it for a long time. You don't quit the strategy midway. You can handle temporary pain. The book says, if you want Magic Formula to work for you, you must first be willing to work for the formula. Meaning the ability to follow the strategy is the real key to success. How to apply the Magic Formula practically? The book advises, create a diversified list of 20 to 30 stocks. Rebalance this list once a year. Hold each stock for at least 1+ year. Adjust sell dates slightly for tax efficiency. Don't use emotions. Follow only the formula. Greenblatt clearly says, most people fail not because the formula doesn't work, but because they don't follow it. Buffett-style philosophy. The book indirectly reinforces several Warren Buffett philosophies. Great companies at fair prices beat average companies at cheap prices. Market is unpredictable in the short term. In the long term, fundamentals win. Mr. Market is emotional. The smart investor should not be. Greenblatt explains, magic formula actually forces you to think and invest like Buffett. Will this formula work for everyone? The book clearly states, if you quit early right-pointing arrow, this strategy is not for you. If you want short-term excitement, right-pointing arrow not for you. If you trust useless news or expert tips, right-pointing arrow not for you. This strategy is for those who are disciplined, logical, long-term thinkers, and take data-based decisions. Greenblatt says, magic formula is simple but not easy. Some practical limitations of this strategy. The book honestly says, hard to apply in very small companies. Sudden market events, crashes, can hurt short-term results. Some industries may temporarily break the formula. Extreme patience is required. But still, long-term data proves this formula beats the market. Conclusion of Part 2. In this section you understood deeply the 2 pillars of magic formula, why earnings yield is important, why ROC is the biggest quality metric, why market psychology is important, why long-term discipline is necessary. Now ahead in Part 3, I will bring for you the easiest way to practically use magic formula's step-by-step investing routine, how the formula has outperformed for decades, and the complete actionable summary of the entire book. So now let's move into the most practical, most action-oriented, and most mind-opening section, that is, how to apply the magic formula in the real world, and how it has beaten the market again and again for decades. How to apply the magic formula in real life. Joel Greenblatt says that to apply the magic formula, you don't need expensive software, complicated analysis, or technical knowledge. You only need patience plus rule following plus simplicity. Here is the complete step-by-step practical process described in the book. Step 1. Include all investable companies in your universe. The book says, avoid very small companies, low liquidity issues. Formula does not work as accurately in certain industries, like financials. So you should create a broad list of mid-large companies. Thus, the starting point is a large universe. Step 2. Rank all companies by quality, ROC. You calculate each company's return on capital. ROC equals EBIT / net working capital plus net fixed assets. If you are ranking 100 companies, the company with the highest ROC right-pointing arrow ranked number 1, the second highest right-pointing arrow ranked number 2, and so on. Greenblatt says, quality is so important that no matter how cheap a low-quality company is, the risk of loss is much higher. Step 3. Rank all companies by cheapness. Earnings yield. Earnings yield equals EBIT / EV. Then, cheapest company, right-pointing arrow, rank number 1. Second cheapest right-pointing arrow, rank number 2. Now you have 2 ranking lists. 1. Quality ranking. 2. Cheapness ranking. Step 4. Add both ranks to create the final magic score. The book says, simply add the 2 ranks. Example. A company is ranked number 2 in quality and ranked number 4 in cheapness. Right-pointing arrow total score equals 6. Another company is ranked number 10 and ranked number 2. Right-pointing arrow score equals 12. The lower the score right-pointing arrow, the better the investment. And here the magic formula shines. Buy the top 20 to 30 companies with the lowest total rank. This combination gives market-beating returns. Why does the magic formula work so well? Greenblatt says the magic formula works because it is a combined attack of 2 powerful ideas. 1. Great businesses. 2. Bought at bargain prices. Normal investors do what? Get stuck in quality, jump into cheap stocks, get trapped in news, get distracted by emotions. But the magic formula avoids all these traps. It is purely data-based rule following. The most important lesson of the book, the magic formula does not work every year. Bold statement from the book, magic formula loses to the market roughly 1 out of every 4 years, meaning about 25% of the time the strategy looks terrible. Greenblatt says this is exactly why it is so profitable. Because when the strategy looks like failing, when people quit, when people run away in the short term, that's when the magic formula gives huge long-term returns. If it worked every year, everyone would adopt it, and returns would disappear. Meaning, the strategy looks simple, but following it is extremely hard. Those who follow it right-pointing arrow become market-beating investors. An example using the magic formula in the style of the book. Suppose the magic formula gives you 30 companies this year. 10 look great. 5 look average. 5 look weird, 10 look so boring you don't even want to look at them. But, Greenblatt says, your job is not to choose. Your job is to follow the rules. Magic Formula catches hidden gems even in boring companies. The market often undervalues boring companies. Magic Formula spots them. That's why you must build the entire basket of 20 to 30 stocks. The real game of rebalancing. The book says, refresh your list every year. Invest in new companies that come to the top. Sell companies that drop out. Hold each stock for at least 12 to 15 months for tax benefits. It's an automated, discipline-driven cycle. Behavioral truth, Joel explains. Greenblatt repeatedly says that most people fail to follow the magic formula because they want quick results. They panic when the market falls. They abandon the strategy midway. They get distracted by social media noise. They change strategy when they see others making money. But the magic formula tells only one thing. Ignore the crowd. Follow the formula. Stay consistent for years. Those who do this dramatically outperform over a lifetime. Joel's most iconic quote, "The hard part is sticking with a strategy that does not always work, even if that strategy works better than anything else over the long run." This is the real test of magic formula investing. Magic Formula's long-term track record, book-based, according to Greenblatt, 17-year backtest, approximately 30% annual returns, more than double the market, better than any professional mutual fund manager. Some years show only 20%, some years show plus 50%, but over 10 to 20 years the returns explode. This is why the book is titled, The Little Book That Still Beats the Market, meaning it still beats the market today. What does the book teach in the end? The book teaches a simple but powerful philosophy. Complicated strategies are not necessary. Predicting the market is impossible. News deceives. Discipline profits. The winning strategy is the one you can stick to. Magic Formula is only as powerful as the patience with which you follow it. Biggest lesson: long-term investing is boring, and boring things produce extraordinary results. The book, The Little Book That Still Beats the Market, teaches us that to get extraordinary results in the stock market, you don't need to be a genius. You just need a simple, tested, discipline-based strategy. Magic Formula is powerful because it picks quality companies, buys them at good discounts, removes emotions, and builds a long-term wealth system for you. If you invest for the long term, if you have patience, and if you follow the rules, then the Magic Formula can open the door to market-beating returns.